Hello everyone, my name is Venkatesh Gaikwad and today I will discuss on the important topic of costs of productions. So what is a cost of production exactly? Whenever a certain product is being made, there are inputs behind that product and those inputs are certain cost that helps creating that product. These components include both explicit and implicit cost. Explicit meaning out of pocket expenses, that is creation of product through wages, rents and raw materials, and implicit cost mainly being the opportunity cost used by owned resources. That is capital itself is a implicit cost and the labor that is inflicted upon that capital to create that product is a explicit cost. This understanding this concept of cost of production will help businesses and firms determining strategies in formulating the price of a particular product. There are many types of cost, mainly being first is the fixed cost. Fixed cost means the cost that remains constant regardless of the level of production. Example: rent, salaries and insurance premiums. These are some of the examples in which the cost of a rent remains fixed for a particular amount of time. Depending upon the scenario, it may increase or decrease, but mostly it is fixed and does not change. Next, short run and long run. These types of cost depend on the nature of the product. For example, a certain product is only being used for a certain amount of time, small amount of time, then the cost will vary. And if a certain product is used for a longer variation of time, the cost of that product will remain stopped or stagnant. That is fixed cost. In short period, it will be varying, but in long run, it will be a fixed price. Third is the variable cost. Variable costs are that costs that change in direct proportion to the level of production. So variable cost is basically raw materials, wages for hourly workers and utility bills. So we take an example of daily wage workers. They work for a fixed amount of time, fixed period of time. They take fixed amount of wages. If they work more, we have to pay more, and these rates fluctuate a lot. It is called as variable. So it changes according to time. Next is the total cost. So total cost is the sum of the total cost or fixed cost or variable cost. That is, when fixed cost and variable cost are added, they create and give an aggregate total. It is called as total cost. You can take example of if a company fixed costs are $1,000 and variable costs are $10 per unit produced, and they produce a total 100 units, then it will be, so we say total cost is 1000 plus 10 into 100, so which gives us total value of 2000. So that is the total cost of that product. Next is the average cost. So average cost is the cost per unit of product. That is, one unit takes how much amount of money to produce. It is the average cost. So if we take an example, if 100 units are produced, the total value is 100. So each unit will be of 1 rupees. So that is, divide the total cost by the quantity of the product, we get average cost, that is cost of a singular product. And in this also we can divide in average fixed cost and average variable cost. Both of the formulas are fixed cost divided by quantity gives us average fixed cost, and variable cost divided by quantity gives us average variable cost. And if we want to take out the average cost, we can just do the addition of average fixed cost and average variable cost. Next is marginal cost. So marginal in this context refers to addition of each unit after the total production or total output. Whenever there is an addition of a unit after the total output is produced, it comes under marginal cost. So formula is marginal cost is equal to change in total cost divided by change in quantity. So to take out marginal cost, we need to understand when certain unit is added to a total, there is a change in total cost as well as a change in quantity. So if that change is to be determined, it gives us marginal cost. Example: if the total cost to produce 10 units is $200 and total cost to produce 11 units is $220, then marginal cost will be, this is the formula, if we apply it we get the answer 20. So that is the marginal cost. Next point is short run and long run business curves, that is graphical representation of the curves due to the cost. So in short run cost curves, average total cost, average variable cost and marginal cost, these are typically in U shaped due to the law of diminishing returns. So law of diminishing returns is after a certain point it will give smaller amounts of utility or smaller amounts of return per cost unit. In long runs, all inputs are variable and firms can adjust all factors of productions. So economics of scale, it is lower cost per unit as production increases. So in long run, we can clearly see though the production is increasing, but the costs are reducing. So this leads to a concept called diseconomics of scale. Next is revenue. As we have seen the term costs of production, there is also revenue concept. What we generate from those after selling that product. That is, first is total revenue. Total revenue is the total income generated from a sale of goods or services. The formula for total revenue is equal to price into quantity. How much is the price of the quantity? If we multiply it, we get revenue. But the point to note here is that revenue isn't your profit. Revenue is the entire amount that you are selling. When you reduce the cost of production from it, then only you will get profit or loss. Second is average revenue. The average revenue refers to the revenue which is earned per unit that you are selling. So that is average revenue, means total revenue divided by quantity. You will get average revenue. Third is the marginal revenue. The same point, when additional revenue is generated from selling one more product, it is called as marginal revenue. The formula is basically marginal revenue is equal to quantity change in total revenue and quantity change in the units sold. If we can do that formula, we get marginal revenue. Last point is break even analysis. So it is a financial calculation that determines the point at which the business total revenue equals the total cost. So same concept is there in the called as market equilibrium, when supply and demand are both similar. But here in the cost of production, when total revenue and total cost sits at a similar place, it is called as break even analysis. So it's a crucial tool because it helps entrepreneurs, investors and business owners to assess the viability of a new product or service if they want to introduce in a market. So the formula is FC, that is fixed cost divided by the price. So when you divide the fixed cost by the price and reduce it, the variable cost per price, when you reduce it, you get the break even point. That is, at what number of units you will earn equal amount of money, equal amount of revenue. That is when it is called as break even analysis. And I have shortly summarized and explained the topic of total cost of production and some revenue related topics. Thank you.